All right, Vuk and I are back to have another one of our conversations about what's happening in markets. Very much looking forward to our conversation today. So, Vuk, tell us a little bit about what's happening in the bond market, what we are expecting, what has been unexpected perhaps this year. Tell us a little bit about what's happening in bond markets at the moment.
Sure, Scott. I think it's a great way to open this conversation because this week we have one of the most important events of the year. Well, of the what's left of the year in markets, and it's not the FOMC meeting on Wednesday. It's actually the Treasury Department meeting that's happening today, and then we get another estimate from them on Wednesday. I'll explain. So last time this happened in July 31st, if you recall. So we also had the FOMC meeting in the same week, but we had the Treasury coming out with its quarterly refunding announcement. And this is something that typically it's usually a non-event, right? It's usually no one cares, right? But this year it's been important, especially that one in July, because it signaled to the markets that the Treasury Department is the deficit is going to be higher than anticipated, the budget deficit. And how do you finance the deficit? You issue bonds, right? So, and that's always a question of the Treasury balancing between short-term and long-term issues, right? Short-term being T-bills and long-term being coupon bonds, 10-year, 20-year, 30-year, whatever. And in July, the Treasury said that they're issuing much more, so a fresh new supply of long-term bonds, which caused havoc in the bond markets because it led to a sell-off essentially. Yields went up. Yields went up from 3.9 on the 10-year to over 5% last week. And in the meantime, the market's S&P dropped for almost 400 period. So so you had the flow from bonds, the sell-off from bonds driving the sell-off in equities, and these two things kind of coalesce together. And this week we're going to see whether or not this continues. So is the Treasury, so the deficit, the U.S. budget deficit is being estimated at 1.7 trillion, something like that, which is enormous even for the United States. It's almost 6% of GDP, and you need to fund that. And how you're funding this, that's the key question on how this affects the supply and demand on the bond market, because as we know, the biggest so there the biggest bond market in the world is the US Treasuries market, and the huge supplier, the main supplier of these bonds is the US government, right? So if the US government decides to issue a huge number of these bonds, huge supply pushes demand down. And on the other hand, with the demand issue, you have the Fed with its quantitative tapering program, lowering the purchase of government bonds. So this is then causing lower demand throughout this year. Essentially, this is what the Fed has been doing continuously. But when you have the problem, that's why yields have been going up. But on the supply side, you have now this crucial impact of the issuer of these bonds, the government, and they have to issue much more of them in order to fund the deficits. So that's kind of the situation that we're coming into this week, right? What's going to happen? So you have this. So today, when we're filming this on Monday, we have their meeting. They're going to come out with a headline number, but what we really should be looking at is Wednesday and how this is going to be structured. So are we getting more long-term bonds or more short-term bonds, and how is this going to affect their prices and hence yields?
Are you anticipating more long-term bonds, more short-term bonds? And can you explain what happens in markets when we get different proportions of long versus
Sure. I mean,
short-term
so the
bonds?
last time this happened, the government had to issue much more long-term bonds. So we're talking about 10-year, 20-year, 30-year duration bonds, which is why the yields on those bonds went up to 5% on the 10-year, over 5% on the 30-year, for example. And because the markets are pricing in new supply coming in, the government needs to issue these bonds in order to close the deficit. And this has been one of the surprising things of the Treasury. Again, not something that typically happens in these quarterly refunding announcements. They're not that important for markets, but this year, amidst an inflationary, still what is still basically an inflationary bear markets, this is very important. Okay, because it tells you of the structure. Now, to answer your question directly, I do expect more long-term bonds to continue issuing more long-term bonds. This is what the Treasury has announced before. This is what Janet Yellen, the secretary, has announced as well. We'll see what happens. We can, we're not going to jump the gun, but it's going to be very interesting to see whether or not this holds true, and if it does, if the Treasury is going to issue many more or much more long-term bonds, we can expect another sell-off, another leg of the sell-off in the bond market. If not, if they decide to issue more short-term bonds, and if their funding requirement is not as big as we're anticipating right now, then that's going to be the signal to buy assets, to buy bonds and buy equities. But if vice versa, then basically we get a strong signal for another sell-off in both equities and bonds. And this is something that we cover on the newsletter, and this is something that would inform our many paid subscribers, including our investors into the fund. So they have this information, and we're going to track it closely on Monday and on Wednesday this week, in addition to whatever happens with the Fed. But however, we can talk about the Fed later. But yeah, this is the key event that we should pay attention to.
Yeah, so if there's you mentioned that this is a fairly new move in the interest in the treasuries, and I think there's in some ways it's obvious, right? We're in a very inflationary moment. There's a lot that's going on in terms of what's happening with US debt and the issuance of debt. So, do you expect that the treasuries and the treasury meetings will be important just in the short term, or do you think that's going to be a bigger emphasis in the longer term with questions about debt and everything that's
Well,
happening
a
with
bit of both.
markets?
It's a great question. A bit of both, I think. In the short term, obviously, because of its immediate impact on the supply of bonds coming into the market, because we know what's happening on the demand side. But in the long term, definitely the situation with debt. So we have to keep in mind that next year in the United States is an election year. No government wants to start a crisis or engage in problems of financing domestic debt during an election year. Yeah.
What?
Surprise, surprise. Yeah.
No way.
So we'll see how the Biden administration handles this. So we have to keep that political implication in mind as well. I don't think that the Treasury definitely does not want a recession next year to hurt the presidency. But at this point, it might be out of their hands because they're kind of between a rock and a hard place, right? So you have this huge deficit, so you need to. So deficit financing is always essentially has a stimulus sort of effect, right? Because the government is pushing in all this money into the economy, but on the other hand, it needs to issue more debt. And when it's issuing debt at 5%, it's not the same when you're issuing debt at less than 1%. And that's the situation that we have. That's the long-term implication that you mentioned, right? So in the long term, it's going to be very problematic because right now, so all the debt that you incurred during COVID, remember we had a lot of stimulus going on during COVID, but this was debt taken at interest rates very close to zero. Now you're taking on new debt, and
Hmm.
you're getting interest rates at 5%. Okay, and that's relatively less sustainable. Let's put it mildly, right? Because every next budget deficit is you're going to have a huge chunk of that deficit is just going to be debt repayments, so interest payments. Okay, because you have to make interest payments all the time, right? So every year you have to pay out interest from the budget, and this widens the deficit essentially. So at one point, and I think what the government might be waiting after the election next year, they're going to have to start engaging austerity measures, right? Cutting spending. I don't see any remote a signal of spending cuts happening this year, next year, but then already in 2025, most likely.
Okay, so let's talk about the election year. And you just talked about how we're going to have to be cutting back on spending, or at least the US federal government is going to be looking at some of those measures. What do you anticipate in the short term from the federal government in terms of from the implications of an election year? And what do you expect in the longer term? Just going a little bit deeper into what you've already
Sure.
been
So in
delving
the short
into.
term, it's fiscal expansion, right? Essentially, and with a deficit of 1.7 trillion, which is almost 6% of US GDP, you have a huge fiscal expansion, a fiscally expansionary type of policy, and that might hurt. Initially it should be good for the economy, right? So that's something that should be anti-recessionary, so to speak. But on the other hand, you have a pull from the bond markets, you have a pull from the equity markets, and if this starts impacting consumers with high interest rates being, as we know, right, already at 5% is the reference one. You have the 30-year mortgages in the United States are at 8%. And if this, we saw the bank earning numbers 2 weeks ago and last week. Uh, uh, Banks are sitting on huge pools of unrealized losses. This is all this entire situation is causing problems eventually, right? So this has to come uh, um, we're going to have to deal with this problem sooner rather than later. The thing is, I don't expect the government to back off next year again because of the election year implication. But then, in 2025, we're going to have to. It's either going to be some version of spending cuts or tax hikes or whatever, or a combination of both, like we had throughout that whole period after the latest financial crisis. Especially if next year we have a recession, we start entering a recession, and then the government does this another, Fed lowers interest rate and government does another stimulus, um, and then we're going to see what happens in 2025, or maybe even 2026. But yeah, the fiscal situation is not looking that bright for the U.S. or for most of Europe or most of the world, actually.
Okay, why do
Yeah,
you
because
why
I
do you
mean,
say
because you
that?
had you
Is
had
that
the COVID thing, right? So remember, so after the last financial crisis, after 2008, budget balances of many countries were in big problems. Debt levels in many countries, in the US, in the UK, around Europe, they went sky high, right? So US debt doubled, UK debt doubled. Some countries saw debt quadrupling because they had to bail out banks. Same thing happened in the United States. And this created a whole, so after 2010, a whole set of problems that had to be solved by fiscal conservatism, essentially. And there was this whole strife between the Obama administration and the Republicans, etc. You had the debt ceiling debates, you had the fiscal cliff problems. All that is basically probably waiting for us in the future, in the near future. We already had that situation in the U.S. Rather recently with the debt ceiling debate, with the debt ceiling problem. Again, at this point, there's still so much money in the economy created by the COVID stimulus, which was the 2008 response on steroids, essentially, the COVID stimulus. And there's still a lot of money there. There's still a lot of money in the economy. This is what we've been talking about. That's one of the reasons why we don't see a recession, because people are still, they have jobs, the labor market is tight, and essentially, there's huge demand for labor still, and people still have money. So that's why spending is not going down as much as it should have been, right? As much as it was anticipated because of interest rate hikes. But again, all of it is slowly moving to the right, say, direction, right? Not the right direction, but the expected direction, right? It's not that I'm saying that a crisis is good. It's something that we're rooting for, even though we tend to make most of our money when markets are going down. However, a recession is never good for the overall economy. But as always, we adapt.
Yeah, so there's meetings that are happening with the treasuries and the markets are looking at that. What else are markets looking
So,
at the
yeah, I
moment?
mean the Fed, obviously, right? The Fed meeting is on Wednesday, but again, I don't expect anything new. I mean, things can always happen. Powell can always go out and say something, but I don't expect anything special. I think they're going to keep interest rates the same level. Will this cause a post FOMC bump? Again, a lot of it depends on what happens with the Treasury decision. I think that's the place to look at, especially in the bond market first. But yeah, because we saw it this week, right, or last week, sorry, with the earnings. So all big tech companies beat earnings significantly, right? And then a lot of them, went down, and the markets in general went down. Even the two that beat earnings significantly, like Amazon and Microsoft, ended up flat for the week. So that's the question of these flows, and that's what we've been seeing for the past 3 months. Essentially, flows are moving from equities into other assets. Okay, they're moving into bonds. Some people are buying bonds because the yields are 5%. This is a good return. With inflation down to 3%, you get a 5% from buying 2-year treasuries or 10-year treasuries. That's a good deal. Essentially, that's what people are doing. Not just like, so we're talking about retail investors, we're talking about pension funds, whatever. So a lot of them are essentially doing this and engaging in this in this structural switch between equities from equities into other type of assets, and that's driving the equity sell-off. Whether or not this continues, again, this is something that we discuss in the paid part of the newsletter, and I'm kind of keeping that to ourselves and our investors and our subscribers. But yeah, that is something that we tend to keep a close eye on.
Okay. Thank
Sure,
you
it
so
was
much,
it was a
Vuk.
pleasure as always. Thanks, Scott.
All right.